Good afternoon, everybody. In Accounting 230, 82078 is the course number. And today we're going to go into Chapter 8, dealing with depreciation and the handling and disposal and accounting for fixed assets. And I guess we can get started right now. I'm not sure if anybody will join today's session. And also keep in mind that I'm going to do a separate video, a brief one, on how to put together your FSA assignment, where we're going to analyze two companies, General Mills and Kellogg's. So let's get going here with Chapter 8 in 230. Chapter 8 in 230. Now, where is Chapter 8? Chapter 8. Let me share this with you, please. Doesn't want to share. What a nasty, greedy. Okay, I'm assuming you can all see the PowerPoint now. There's nobody here to tell me otherwise, so I guess I'll keep going. Okay, we're going to talk about property, plant, and equipment, but also we're going to be talking about intangible assets that you might find interesting, and about natural resources. And one note you might make is that you depreciate physical assets, you amortize intangible assets, and you deplete natural resources. So let's get going. Classifying long-term assets. Long-term assets, they're actively used in the business and they're expected to last a long time, and they're big ticket items, costly items. Tangible, you can actually touch them, you can look at them, you can hold them, you can strike up against them. Intangibles, you can't see them. They don't exist physically. It's intellectual property we're talking about with intangibles. Patents, trademarks, copyrights, franchise fees, there's all kinds of things. Goodwill. Classifying long-lived assets. Land is a long-term asset. Assets subject to depreciation are buildings and equipment, furniture and fixture. And then we have natural resources. Those are the tangible ones, okay? The intangible ones would be your patents, copyrights, franchise fees, goodwill, trademarks. You depreciate physical assets, except land. You never depreciate land, but you do depreciate buildings and furniture and fixture and cars and vehicles. Here is a metric that they probably should have put at the end of this chapter, but make this note that you're going to need this on your second of probably going to be 3 FSAs. You're going to have to come up with the fixed asset turnover, which is simply the net sales for a year divided by the average net fixed assets. And of course, the average net fixed assets means the balance at the end of the prior year, the balance at the end of the current year averaged out divided by 2. And so what you have here is a situation where this company here, Southwest Airlines, has 1.38 fixed asset turnover. This means that they turn over their fixed assets 1.38 times per year. The higher, the better on that. So they're generating not quite as much as Delta or United. Measuring and recording acquisition cost. Just like we might have talked a little bit about in the world of raw materials or merchandise we purchase, the acquisition cost of a fixed asset very often goes beyond what the vendor charged you for the machine. For example, beside the purchase price, there could be renovations that we need to do at our own factory to bring this machine in. There may be some repairs we need to do first. There could be title fees, there could be legal fees. There could be all kinds of different things with a building. With equipment, you might have installation costs. You bought a piece of equipment, and to get it into your factory, you need to knock down a part of a wall. The cost of doing that would become part of the price of the asset. Modification to building necessary to install equipment. Maybe you bought a piece of equipment that needs a dedicated electrical circuit of some kind, some special handling. And of course, your freight, your transportation costs, all of those things could be added to the price of the equipment itself. And that total cost would be your debit to equipment. Land, we just talked about, has all kinds of other things. You got real estate commissions, you got insurance premiums, surveying fees, title searches, insurance probes. There's all kinds of things. And land is not depreciated. So let's take a look here. We're going to get started. We're going to look at Southwest Airlines is going to be our company in this chapter. Southwest Airlines went out and they bought a plane, huh? And they paid cash for it. Isn't that nice? They went out and they went to Boeing and they said, we want to buy a 747 from you, please. And Boeing said, that'll cost you $75 million. And Southwest Airlines said, no problem. So they debit the equipment, they credit cash. Southwest Airlines then in the next scenario said, look, we don't have $75 million to pay you. We only have $1 million, but you can trust us for the other $74 million. And Boeing says, I trust you. So they set the deal up this way. They're going to debit the equipment for $75 million, credit cash for the $1 million, and Southwest Airlines takes on a note, meaning they're going to be paying the $74 million plus interest over the next period of years. Or you can buy the plane without any cash. Record at the current marketplace the market value of the consideration given. So here, Southwest gives Boeing 1 million shares of par value stock with a market value of $50 a share, plus $25 million in cash. So again, we're buying a $75 million plane and we're putting down $25 million in cash. The par value of the million shares is $1 million. Remember, wherever you see common stock on your financial statements, it's always going to be the par value multiplied by the outstanding shares. And the paid in capital is 49 million. So they're just showing you different ways you can swing the deal. Doesn't have to be all cash. Or you can build the asset yourself. Not that I'm an expert in this, but when our factory in downtown Los Angeles was demolished in the October 1st, 1987 Whittier Narrows earthquake, it was rather unforgettable. One day you have a building and the next day you don't. What I'm getting at is the corporation funded us to build a new building in Baldwin Park, California. And we pretty much put that building together by ourselves. So all of the costs of that job, the material, the labor, the overhead, the interest on the debt during the deal, all of that had to be added up, and that became the cost of that new building, that new asset. Here's something kind of important, worth a couple points on the test, and you need to know it. Understand the difference between a repair and a maintenance and an improvement. Repairs and maintenance, these are the normal repairs you would expect in keeping a piece of machinery going. You know, you buy a car, you have expenses that maintain the normal operating condition, doesn't really increase productivity, doesn't extend the life of the car really. It's recurring and you have to do it every once in a while at small amounts of dollars. You buy a new car. Well, you're going to have to change the oil every 3,000 miles. That's just ordinary repairs and maintenance. You rotate the tires every, 25,000 miles. Ordinary repair and maintenance. That's an expense. You would debit car expense or repairs expense. That is not the same as an addition or an improvement. Here we're talking big money used to prepare a major overhaul or partial replacement of the equipment. It occurs infrequently, and it will increase the life and efficiency of the asset. And we're talking pretty good money. Getting back to my car example, you buy a new car, and then you decide that you're going to overhaul that engine, you're going to change it from a 4-cylinder to a 6-cylinder Dodge Challenger type 289-liter engine. Well, that's a whole new car you just built practically. That would be debited to the fixed asset called vehicles. So know the difference between repairs and maintenance versus an improvement to an asset. The key thing to remember is if it's an expense, it goes right to the income statement. And if it's a capitalized item, it goes to the balance sheet. Okay. Depreciation concepts. Well, we know some of this already. Depreciation is the process of allocating or estimating, if you want to use that word, the cost of buildings and equipment over their productive lives using a systematic and rational method. That's a GAAP term. So on the balance sheet, we acquire an asset, but we're allowed to expense it off to the income statement over a period of time. The depreciation expense goes to the income statement. The accumulated depreciation goes to the balance sheet. Our journal entry is always the same. It's going to be debit depreciation expense, credit accumulated depreciation, which is a contra asset account. So at the end of each period, there's going to be an adjusting journal entry where you do just that. You debit depreciation expense and you credit accumulated depreciation. Let me close the door here. I think the garden is coming through with some loud equipment. Sorry for the interruption. So you're going to make the same entry every month. Debit depreciation expense, credit accumulated depreciation. That's the allocating of expense. Now, depreciation concepts. We have to be familiar with the acquisition cost, which we just discussed. The acquisition cost of an asset can include a lot more than the invoice price of the goods. We also have to come up with the estimated useful life of the asset and any scrap value or residual value. Scrap equals residual. And then we're going to go into 3 depreciation methods, one of which you already know, straight line. And then we're going to go into units of production and an accelerated method, okay? And I hope you kind of enjoy this chapter. I think this is fairly interesting stuff. Straight line. You bought a plane, not a plane, but ground equipment. You know, they bought a couple of those trams you see them loading your baggage onto. So they bought a couple of those and they paid $62,500 in cash, 3-year life, estimated residual scrap value 2,500. Well, we should know under straight line, we do not depreciate the scrap value. So we must subtract that from the original cost of the asset. So we're only going to depreciate $60,000 over the 3 years, or 20,000. So we're going to debit depreciation expense, credit accumulated depreciation. So let's take a look at our grid here. The undepreciated balance is 62.5. That number is going to be the same no matter what the method is, because that's what you paid for the asset. But we're only depreciating, in this case, 60,000. The first 2 columns are your journal entry. The first 2 columns represent your journal entry. You're going to debit depreciation expense for 20, credit accumulated depreciation, et cetera, et cetera. You do that for 3 years. Look at over here now. Your accumulated depreciation balance. Well, after the first year, it was 20,000. After the second year, it was 40,000. And at the end of the final year, you fully depreciated the asset. 20, 20, 20, 20, 40, 60. Let's take a look at the book value, what's called the book value. The book value. Well, it was 62.5 when you bought the machine. We subtract 20, we get down to 42.5. We subtract 20, we're down to 22,500. We subtract the remaining 20, we're down to the residual value of 2,500. And it's important to note that you can never, no matter what the method is, never go below the net book value, can never go below the salvage value. Okay? Net book value can never go below the salvage value. And they're making a point here that more companies use straight line reports than all the other methods combined because it's easy, I think. It smooths things out over a period of time. But you do have choices. Let's look at this one now. Here, they bought the same ground equipment under the same scenario. Only here, they're not depreciating it by year. They're depreciating it by the mile. By the mile. Units of depreciation. The units here are the mile. If it was a machine, it could be the number of dice stamps or something. So let's see what we have here. We have purchased ground equipment for 62.5, same as before. Estimated useful life of, well, they're not telling us there, but we know it's 3 years. And estimated useful, yeah, we know it's 3 years, but we don't care. Estimated useful life of 100,000 miles and an estimated scrap value of 2,500. If the equipment is used 30,000 in the first year, what's the amount of depreciation? Well, we're going to take the cost, 62,500. We're going to subtract the $2,500 residual value. That gives us 60,000. We're going to divide into that the 100,000 miles. So that comes out, if I did it right in my head, 60 cents a mile, right? So take a look at this. Units of production method. The units are miles. 62.5 minus the 2,500, 60 over 100 or 6 over 10, if you is 60% or 60 cents per mile. They drove 30 miles the first year. 30 times 0.6 is 18,000. They drove 50,000 the next year, 20,000 the next year, etc. So your accumulated depreciation balance went from 18 to 48 to 60, and we're back down to the $2,500 net book value. If they drove this car another 10,000 miles, we were not allowed to depreciate it. And maybe they kept this car for 200,000 miles. It worked out a lot better than they originally thought. So that's one, it's two of our three methods. Accelerated depreciation method. It matches higher depreciation expense with higher revenues in the early year. Let's make this a little clearer. You see where it says declining balance method? Add the word double. I want you to think of this as double declining balance. That's how I learned it. And that's how many textbooks express it. Double declining balance, double declining balance. I guess you could have triple declining, but I've never seen it. Double declining balance. And to make it as simple as we can, we mean double whatever the straight line rate would have been, okay? So let's see what we have here. We have the same machine purchased under the same scenario. Calculate the depreciation expense for the first year, huh? Double declining balance rate is double the straight line rate. So the straight line rate was 1/3 a year, right? It was 3 years. Straight line was 1/3. This means that in the first year, under this method, we're going to double that 33% up to 66. So let's take a peek here. Year one depreciation. We bought a machine for $62,500. We are allowed to use what's called double declining balance. Double declining balance is double the straight rate. The straight rate was 1/3 per year. Double declining balance means 2 times 1/3 is 2/3. So the first year, we're chewing off a giant piece of depreciation expense, which brings the net book value down to 13,889. So let's take a look at the grid here. 62.5 times 0.67 or times 2/3. 41,667 is your debit to depreciation expense. It's your credit to accumulated depreciation. And look at the net book value, went way down from 62.5. Well, what's the net book value at the end of the first year? It's 20,833. Let's multiply that by 0.67 or 2/3. You get 13,889. 13,889 plus the 41667 gives you the 55,556 accumulated depreciation balance on your balance sheet, and it reduced the net book value down to 6,944. We take 6,944 and we do the same thing. Multiply it by 2/3, we come up with 4,629, and that brings the net book value down to 2,315. But that's a problem. Why is it a problem? Because we can never go below the residual value, which in this case is $2,500. So we're going to have to tweak this. We're going to have to tweak it. You see where it says 4,629? We want to tweak it by stepping on that 4,629 with the number we need to equal 2,500. Okay? In other words, another way to do it, it's simply 6,944 minus 2,500 gives you the correct number. So the accumulated depreciation method, called double declining balance, is the tougher one. It makes you think a lot more. Yeah, double declining balance. What the heck does that mean? It means double the straight line rate. So, for example, if you had a 5-year straight line rate, that's 1/5. Make it 2/5 for double declining balance. And yes, you are really front loading a lot of the depreciation expense in the first year or two of the asset. And that's one reason companies might choose it, to come up with a nice tax deduction immediately and make their financial statements look that much better. Remember, depreciation expense is limited to the amount that reduces book value to the residual value. International perspective, tax reporting, impairment of an asset. We'll get into that a little bit later here. Okay, now we need to maybe sell a fixed asset. We have a fixed asset that we're not using anymore. It's still in good shape, but we don't need it any longer. That technology is unnecessary. So we might have a disposal of it voluntarily. We might sell it, trade it in, or retire it. Or we lose it in an accident or a fire, or somebody rams a forklift into it by mistake. Disposal of property, plant, and equipment, huh? We have to update the depreciation to the date of the disposal, and we have to journalize the disposal. We debit cash, and we're going to record a gain or a loss, and we have to write off the accumulated depreciation and write off the original asset cost. Let me simplify that, okay? Let's take it, let's see if they give us something a little more clear, okay? Let's say it this way. You have a machine. Southwest Airlines sold flight equipment for $11 million at the end of its 17th year. After 17 years, Southwest Airlines sold this piece of equipment. The equipment originally cost $30 million and was depreciated over a useful life of 25 years. Okay? Was over a period of 25 years. So let's look at this. A simple way to do these disposal problems is as follows. And I'm going to give you a couple simple ways. Net book value of the asset minus the cash you receive is the gain or loss. Let me repeat that. Net book value minus the cash that someone paid you for the asset is the gain or loss. So let's see what we have here. They sold it for 11 million. The flight equipment originally cost 30 million and was depreciated using the straight line method, zero residual. Oh, they took the fun out of it. They gave us the answer. The amount of depreciation expense recorded at the end of the 17th year is how much? Well, we know it's straight line. They told us that, right? Straight line depreciation, zero residual. So 30 million divided by 25 years is $1.2 million per year. Okay. That was the same from years 1 through 17. Now it's year 17, we're getting rid of the machine. After updating the depreciation, what is the book value of the machine? Well, the machine cost us $30 million. We've depreciated it for 17 years at $1.2 million. So your accumulated depreciation at the time of the sale is $20,400,000. On your financial statements, on your balance sheet, you will see this line right here, $20,400, representing the balance of accumulated depreciation. The original cost of the asset is 30 million. That will also be on your financial statement balance sheet. The difference is the net book value. Keep in mind, we have to get rid of both the original cost of the asset as well as the accumulated depreciation. So let's see what they ask next. The equipment sale resulted in a gain or a loss. Well, let's see what we're talking about here. How much did they sell it for? They sold it for $1 million. What was the net book value? $9,600,000. You have a gain of $1,400,000. Okay? Net book value minus the cash received equals the gain or loss. Equals the gain or loss. Now let's look at the journal entry. Let's look at the journal entry, because on the test, you're not going to have to prepare the journal entry, but they're going to give you questions that will say what goes on to this journal entry, in essence. So we need to prepare the journal entry to record the sale. Again, I say to you, let me make this simple. Copy these 4 lines down and you can't go wrong. Every disposal of a fixed asset is going to have a debit to cash. It's going to have a debit to the accumulated depreciation, which is a contra asset with a credit balance. So we have to zero that out. We have to remove the original cost of the asset, which in this case was $30 million. You just add the 2 columns up and squeeze to get the gain of $1,400,000. Okay. So on the test, you might get a true or false question. In disposing of a fixed asset, you debit accumulated depreciation. And the answer is yes. Yes, you do. Because you got to get rid of the accumulated depreciation plus the flight equipment. Let's have a little bit of fun with intangible assets, huh? Non-current assets. These are long-term assets. And the life is often difficult to determine. It gives us rights or privileges to do something. Only purchased intangibles are recorded, and they are normally recorded at current cash, whatever the cost was, including legal fees, flying fees. Let's set that aside for a moment, the notion that only purchased intangibles are recorded. We'll get to that in a short while. Acquisition and amortization of intangible assets. If we have a definite life, and we can use the straight line method. In fact, that's the only method, straight line amortization. If the life is indefinite, we just can't amortize it. We can't do anything with it. All we can do is test it for impairment and see if we're still getting our money's worth. If not, we have to adjust. Amortization is a cost allocation process similar to depreciation and depletion. Goodwill. We're going to get a lot of goodwill in a couple of weeks when we get into chapter. When we get to Appendix A in the book. Goodwill. It occurs when a company buys another, only purchase goodwill. Goodwill, for now, all we need to know, it's the amount by which the purchase price exceeds the fair market value of the assets. In other words, you buy a company and you determine that that company is worth $1 million. You know it's worth $1 million. You know that the equipment is worth this amount. You know how much cash they have. You know what the fixed assets are worth, what the debt load is. It's worth $1 million. You go to me, you want to buy my company for $1 million. I say, no, I'm not selling for $1 million. And you say, why not, Bob? Your company's only worth $1 million. I say, you got to do better than that. So maybe you offer me $1.2 million and I accept it. That difference of $1.2 million and the $1 million that the company's really worth is called goodwill. And it goes on your balance sheet as an asset. As long as that company continues to generate the expected cash flows. RPEC paid $2 million to purchase UTEC. RPEC paid $2 million to purchase all of UTEC company. So they paid $2 million. The liabilities on UTEC were $400,000, and the assets were appraised at $1.8 million. So this company had assets of $1.8 million. It had liabilities of $1.4 million. So the fair market value of everything is $1.4 million. There's our accounting equation. We paid $2 million. And that means we paid $600,000 over the fair market value. And that can happen. Companies might pay a lot more. You might be looking at my company again, the Bob Smagula company, and you're saying to yourself as a business person, geez, Bob's company is so poorly run. If we took over Smagula Industries, we could build that company up into a giant conglomerate. We'll get our money back 10 times over. I know we can. But Bob won't sell for $1 million. They say, offer him $1.2 million. And we made the deal. Acquisition and amortization of intangible assets. Know what these things are. A trademark. It's a symbol, logo. The McDonald's arches, Coca-Cola's logo, okay? The Toyota T. These are all trademarks. It's an exclusive right to use a name, image, or slogan. You can't open up a restaurant, a hamburger place next to McDonald's and build it with big arches and call it McDennis's. You can't do that. The trademark protects you. Copyrights are the right to publish a book. Gives exclusive right to publish or sell literary, musical, or artistic work. And the legal life is 70 years plus beyond the life of the creator. So, for example, Herman Melville wrote Moby Dick back in 1850, I believe, was around that time. He lived till about 1880. He died. It wasn't until 1950 that anyone else could publish that book. So we're going to amortize trademarks and copyrights over the life of the intangible asset. And we have a couple more. The one we're going to talk about the most are patents. Exclusive right granted by the government to sell or manufacture an invention. The cost is going to be the purchase price plus any legal cost. And we're amortizing over 20 years. Patents have a 20-year life, okay? The life starts from the day the patent is granted by the government. Research and development costs that might result in a patent are normally expensed. And let's talk about that for a moment. Companies are trying to come up with new products. Pfizer worked like crazy to come up with the vaccine for COVID-19. They spent a couple of years doing that. All of those expenses that they incurred were considered part of the income statement. They didn't capitalize them. They were not allowed to. So they, in essence, got a huge tax break because all of their research and development is an expense and thus tax deductible. So when Pfizer came up with the patent for the COVID-19, they could not put that on their balance sheet as an asset. They own it, and it certainly is an asset, but all they can do with that patent is put a nice picture frame around it and hang it on the wall. Now, Pfizer might say, man, we invented this vaccine, but we don't want to produce it. We don't have the capacity to produce it. They may sell the patent to somebody else. They may sell the patent to Johnson & Johnson. Johnson & Johnson looks at it and says, wow, this is some big money here. So maybe for billions and billions of dollars, they sell the patent to Johnson & Johnson. Johnson & Johnson now can put the patent on their balance sheet. Okay? Patents. And then you have franchise fees, your McDonald's and your Denny's and places like that. Research and development expenses are not intangible assets. The cost to develop an intangible asset is normally recorded as R&D expense. And that's what I was talking about earlier. That's why the company who creates the invention, the company who was granted the patent, cannot put that asset on their financial statements as an asset. It's just a piece of paper that says you own this patent, and only you and you alone can make this product. Nobody else can make this product but you. That's what the patent does. If you want to sell the patent to somebody else and let them make it, that is up to you. And that happens a lot. A guy invents something, and it's a great invention, and there's obviously a big market for it, but the inventor is not interested in opening up a factory to produce this stuff. You know, he just came up with the invention. He would probably cash in by selling the patent. International, we don't worry about. So that was just a little bit about intangibles. There should have been a little more, I think. And in a subsequent talk, I'll mention that. When we go through the test review, I'll make sure I cover everything that I feel is appropriate. They didn't show us the journal entries, and they didn't show us some calculations that we need to know. And then finally, we get to natural resources. Remember this from grammar school and high school. Now, what are natural resources? The land, water, timber, a gold mine, precious metals. These natural resources are extracted from the natural environment. And the total cost of the asset is how much it costs to dig it out of the earth. The cost of acquisition, exploration, and development. It's a non-current asset presented at cost less accumulated depletion, and the total cost is allocated over periods benefited by the depletion. In other words, you struck oil, and it took you $10 million to strike oil. Well, that $10 million is your asset called an oil well. And you are going to deplete the oil well by every gallon of oil you take out of the earth. Remember, we did the units of production method earlier when we were doing the fixed assets of tangible assets. The one where we had the $60,000 car that was going to be driven for 100,000 miles, and we came up with 60 cents a mile. If you understand that, you understand depletion. We're going to take the acquisition cost minus the residual value and divide it out by the number of recoverable units. In an oil well, it's probably barrels. In a gold mine or a coal mine, it probably, well, a coal mine, it would be tons. I don't think you'd get tons out of a gold mine, but that would really be a gold mine if you did that. So here's what we're doing. The depletion cost is going to go into the inventory, either through cost of goods sold or it's unsold. And they're just showing you here that we're going to debit depreciation and amortization expense Operating activities, oh, this is cash flows. I'm sorry. I thought they were continuing with depletion. Let's ignore this. We don't need this. And that's pretty much the end of the chapter. Now, they didn't give us nearly enough on depletion of a fixed asset. Essentially, you have an oil well for $10 million, and you expect to get out of that oil well 20 million barrels of oil. Well, that's 50 cents a barrel that it cost you to get that oil out of the ground. So every time you have a barrel of oil come out, you're going to debit depletion expense and credit accumulated depletion. Okay. So that's pretty much the end of the chapter here. We're not going to go into the supplement. And thank you for hanging in with me. It's about 2:11, so we did about 40 minutes here. I think that was a fair amount of time. And also today, I'm going to put up on Canvas and on my YouTube channel, maybe 5-10 minutes at the most on preparing the first FSA assignment. You get that first assignment clear in your mind, it makes the rest of them a lot easier. Okay. So with that in mind, I'll say goodbye to my audience. I imagine there are thousands of people listening into this as I speak. And it is to them I say, have a good day, and we'll see you later. Bye-bye.